Market crashes are often seen as moments of fear and destruction, but from Warren Buffett's perspective, they are also moments of clarity and opportunity. Buffett has consistently explained that a market crash is not the same thing as a business collapse. Prices may fall sharply, headlines may turn negative, and panic may spread, but strong businesses do not suddenly lose their true value overnight. Buffett views the stock market as a place where emotions dominate in the short term. During crashes, fear replaces logic. Investors focus on daily price movements instead of long-term business performance. This emotional behavior creates mispricing, where excellent companies trade at prices far below their intrinsic value. Buffett believes this is when patient investors are rewarded. One of Buffett's core beliefs is that volatility is not risk. Risk comes from not understanding what you own. During a crash, volatility increases, but if the underlying business remains strong, the real risk may actually decrease because the price becomes more attractive. Buffett welcomes volatility because it gives him the chance to buy quality businesses at discounted prices. He often compares market crashes to sales in a retail store. When prices drop on items you already wanted, you don't panic, you feel excited. Buffett applies the same logic to stocks. If he admired a business at a higher price, a lower price makes it more appealing, not less. Buffett also emphasizes preparation. He does not wait for crashes to think about what to do. Long before a downturn, he studies businesses, builds cash reserves, and decides what types of companies he would like to own at the right price. When a crash arrives, he is ready to act while others are frozen by fear. Another key element of Buffett's perspective is liquidity and balance sheet strength. During market crashes, companies with heavy debt struggle to survive, while companies with strong cash flows and low debt gain an advantage. Buffett focuses on businesses that can endure economic stress without relying on external financing. He also warns against trying to predict the exact timing of market crashes. Buffett admits that no one can consistently forecast when markets will fall or recover. Instead of predicting, he focuses on positioning himself so that whenever a crash happens, he is financially and mentally prepared to take advantage of it. Buffett's calm during crashes comes from his long-term mindset. He invests with the expectation that markets will fluctuate many times over decades. Short-term declines do not matter to him because his holding period is measured in years, not weeks or months. In Buffett's view, market crashes reveal character. They expose who invested based on speculation and who invested based on business fundamentals. Those who understand what they own remain calm. Those who chased quick gains panic and sell at the worst possible moment. This perspective transforms crashes from terrifying events into strategic opportunities. For Buffett, a market crash is not a signal to run away, but a test of discipline, patience, and conviction in long-term value. Warren Buffett's approach during market crashes is deeply rooted in discipline and rational thinking. While most investors react emotionally, Buffett focuses on facts, fundamentals, and long-term outcomes. He believes that crashes are the result of mass psychology rather than sudden changes in the real economic value of businesses. During a crash, Buffett pays close attention to the difference between price and value. Price is what the market offers in moments of panic, while value is what a business is truly worth based on its earnings power, competitive advantage, and future prospects. Crashes widen the gap between these two, and that gap is where opportunity lives. Buffett often explains that the stock market is a voting machine in the short term and a weighing machine in the long term. In a crash, fear dominates the voting process. Investors vote with their emotions, not with logic. Over time, however, the weighing machine takes over, and strong businesses are valued based on their real performance. Buffett positions himself to benefit from this shift. Another critical aspect of his perspective is patience. Buffett does not rush to buy the moment prices start falling. He understands that crashes can unfold in stages. Instead of trying to catch the exact bottom, he waits for clear signs that prices offer a significant margin of safety. He prefers being approximately right rather than precisely wrong. Buffett's historical actions during major crashes reflect this philosophy. In periods of extreme fear, he has invested large amounts of capital into strong companies that were temporarily out of favor. These decisions were not based on market timing but on confidence in long-term cash flows and business resilience. He also emphasizes the importance of cash during downturns. Cash gives flexibility and power when others are forced to sell. Buffett often keeps substantial cash reserves, even when markets are rising, because he knows that crashes create rare opportunities that require immediate action. Without cash, even the best ideas cannot be executed. Buffett warns investors against leverage during market crashes. Borrowed money magnifies losses and forces selling at the worst possible time. He has consistently avoided excessive debt because crashes expose financial weakness. Survival, in Buffett's view, is the first rule of investing. Another element of his thinking is selective action. Buffett does not try to save every falling stock or invest in every cheap-looking company. He narrows his focus to businesses he understands deeply. Complexity increases uncertainty during stressful periods, so simplicity becomes a strength. He also rejects the idea that market crashes signal the end of capitalism or long-term growth. Throughout history, markets have crashed many times due to wars, recessions, political crises, and financial bubbles. Yet over time, productive businesses have continued to grow. Buffett anchors his confidence in this historical reality. Buffett's emotional stability during crashes comes from preparation and experience. Having lived through multiple downturns, he understands that panic is temporary but ownership in strong businesses can last decades. This perspective allows him to act decisively while others hesitate. For Buffett, a market crash is not chaos but information. It reveals which businesses are strong, which balance sheets are weak, and which investors lack conviction. Those who stay calm, think independently, and focus on value can turn market turmoil into long-term advantage. Warren Buffett places enormous emphasis on mindset during market crashes, believing that psychological strength is the ultimate competitive advantage. When markets fall sharply, information does not disappear, but clarity does. Investors who can think clearly under pressure gain an edge that has nothing to do with superior intelligence. Buffett often says that the worst decisions are made when emotions override logic. Fear convinces investors that the future will permanently resemble the present crisis. During crashes, people assume that declining prices signal permanent damage, even when evidence suggests otherwise. Buffett resists this instinct by anchoring his decisions to long-term business economics. He separates news from noise. Headlines during crashes are designed to capture attention, not provide balanced analysis. Buffett avoids constant exposure to market commentary because it amplifies fear. Instead, he studies financial statements, competitive positioning, and long-term demand for a company's products or services. Another critical principle in Buffett's crash philosophy is ownership thinking. He does not view stocks as symbols on a screen but as partial ownership in real businesses. If he would be comfortable owning the entire business during a downturn, then temporary price declines do not disturb him. This mindset transforms volatility into something manageable. Buffett also believes that crashes punish speculation and reward conviction. Investors who bought assets without understanding them are the first to panic. Those who invested with clear reasoning and long-term expectations are more likely to hold or even add to their positions. Crashes expose the difference between hope-based investing and knowledge-based investing. He frequently emphasizes the importance of time horizon. A short time horizon turns volatility into danger, while a long time horizon turns volatility into opportunity. Buffett invests with the expectation that markets may be closed tomorrow and remain closed for years. This extreme assumption protects him from reacting to short-term fluctuations. Diversification, in Buffett's view, has limits during market crashes. Over-diversification can dilute understanding. He prefers concentrated positions in businesses he knows deeply. This allows him to maintain confidence during downturns because his knowledge replaces fear. Buffett also focuses on management quality when evaluating companies during crashes. Strong leaders make rational decisions under stress, protect shareholders, and allocate capital wisely. Weak leadership often reveals itself during difficult periods, turning temporary market stress into permanent business damage. He avoids the temptation to predict recovery speed. Some crashes recover quickly, others take years. Buffett does not build his strategy around recovery timelines. His focus remains on whether the business will be stronger, weaker, or roughly the same 5 to 10 years into the future. Another overlooked aspect of Buffett's perspective is humility. He accepts that he cannot foresee every outcome. This humility leads him to demand a margin of safety and to avoid situations where survival depends on perfect conditions. Crashes reward those who prepare for uncertainty rather than deny it. For Buffett, the true danger in market crashes is not falling prices but forced decisions. Investors who lack cash, use leverage, or rely on short-term funding lose control over their actions. Buffett structures his finances so that no market condition can force him to act against his will. Ultimately, Buffett sees market crashes as moments that reset expectations and reward rational behavior. Those who maintain discipline, think independently, and stay focused on long-term value emerge stronger, while emotional decision-making leaves lasting damage. Warren Buffett views market crashes as defining moments that separate long-term investors from short-term speculators. In these periods, he believes the most important question is not how much prices have fallen, but whether the underlying businesses remain capable of creating value over time. He often highlights the concept of endurance. A company's ability to survive economic stress determines whether a market crash becomes an opportunity or a trap. Businesses with strong balance sheets, consistent cash flow, and durable competitive advantages tend to emerge stronger, while fragile businesses disappear or permanently decline. Buffett stresses that doing nothing is often the most intelligent action during crashes. Constant activity creates the illusion of control, but frequent buying and selling usually destroys value. Patience allows facts to unfold and prevents emotional overreaction. Buffett is comfortable waiting while uncertainty resolves itself. Another core element of his thinking is independence. During market crashes, consensus opinion becomes extremely negative. Buffett deliberately avoids crowd behavior. He understands that if everyone agrees on a pessimistic outlook, prices already reflect that fear. Independent thinking allows him to act when others cannot. He also emphasizes learning from history. Every major crash feels unprecedented to those experiencing it, yet patterns repeat. Economic systems adapt, innovation continues, and strong businesses survive. Buffett studies past crises not to predict the future but to understand human behavior under stress. Buffett rejects the idea that markets are casinos. Short-term traders treat crashes as events to exploit through timing and speculation. Buffett treats them as periods to reassess ownership in real businesses. This philosophical difference shapes his calm and consistency. Another important principle is selective courage. Buffett does not try to appear brave by buying recklessly. His courage is grounded in analysis and conviction. When he acts during crashes, it is because he sees long-term value clearly, not because he wants to prove confidence. He also acknowledges that mistakes are unavoidable. Even well-researched investments can suffer permanent damage. Buffett accepts this reality and limits position sizes to protect overall capital. Survival and consistency matter more than perfection. Buffett's long-term success comes from aligning behavior with reality rather than emotions. Markets fluctuate, economies cycle, and uncertainty is permanent. By accepting these facts, he removes the emotional shock when crashes occur. In his view, the greatest advantage during market crashes is the ability to remain rational. Rational investors do not panic, do not chase predictions, and do not abandon discipline. They focus on value, resilience, and time. For Buffett, market crashes are not obstacles to long-term wealth creation but essential components of it. They cleanse excess, reset valuations, and reward those who are prepared, patient, and disciplined enough to act when fear dominates the market. Warren Buffett ultimately sees market crashes as unavoidable events that test an investor's philosophy more than their analytical skills. He believes that anyone who invests for decades must accept crashes as part of the journey rather than exceptions to it. Avoiding fear is not realistic, but managing fear is essential. One of Buffett's most powerful beliefs is that time favors well-chosen investments. Short-term market declines lose their importance when ownership is measured in decades. Buffett structures his investments so that he benefits from long-term economic growth, productivity, and human innovation, all of which continue despite periodic crashes. He often reminds investors that owning equities means accepting volatility as the price of superior long-term returns. Those who demand stability at all times often sacrifice growth. Buffett embraces volatility because it allows disciplined investors to acquire valuable assets at attractive prices. Buffett also emphasizes personal responsibility. He does not blame markets, governments, or economic conditions for investment outcomes. Each decision is judged based on logic and preparation. This mindset removes emotional excuses and strengthens long-term discipline. Another key idea in his philosophy is trust in compounding. Crashes interrupt compounding temporarily, but they do not destroy it unless investors panic and sell. By holding strong businesses through downturns, compounding resumes and often accelerates when conditions normalize. He cautions against overconfidence after recoveries. Just because markets rebound does not mean risk disappears. Buffett remains cautious even during optimism, knowing that future crashes are inevitable. This balance between optimism and caution defines his consistency. Buffett also highlights the importance of aligning investments with personal temperament. Strategies that look good on paper fail if they cause emotional stress. He advises investors to choose approaches they can stick with during severe downturns. He believes that success during crashes is less about bold moves and more about avoiding destructive behavior. Not panicking, not using leverage, and not abandoning discipline often matter more than finding perfect opportunities. For Buffett, wisdom lies in understanding that markets serve investors, not guide them. Prices are tools, not instructions. During crashes, lower prices offer opportunity, they do not issue commands to sell. In the end, Buffett's perspective transforms market crashes into moments of reflection and opportunity. Those who remain patient, rational, and committed to long-term value are rewarded, while those who chase emotions pay the price. Market crashes, in Buffett's philosophy, are not the enemy of wealth creation. Emotional reactions are. By mastering behavior, respecting risk, and trusting time, investors can turn even the darkest market periods into foundations for lasting success. In Warren Buffett's philosophy, the final lesson of market crashes is simple but demanding: behavior determines results. Knowledge, analysis, and experience all matter, but without emotional discipline, they lose their power. Crashes expose whether an investor truly understands this truth. Buffett believes that markets exist to transfer wealth from the impatient to the patient. Crashes accelerate this transfer. Those who cannot tolerate uncertainty sell their assets at unfavorable prices, while those who remain calm quietly accumulate long-term value. He consistently returns to the idea of preparation over prediction. Buffett does not try to forecast when crashes will happen or how deep they will be. Instead, he prepares his finances, mindset, and portfolio so that no crash can threaten his survival or force irrational decisions. Another central insight is acceptance. Buffett accepts that discomfort is part of investing. Expecting markets to always rise is unrealistic. Once investors accept declines as normal, fear loses much of its power. Acceptance turns panic into perspective. Buffett also stresses that simplicity protects investors during chaos. Complex strategies, excessive leverage, and constant trading create fragility. Simple ownership of strong businesses, bought at sensible prices, creates resilience. He reminds investors that opportunity rarely feels comfortable. The best investments often appear during periods of pessimism, when confidence is low and uncertainty is high. Waiting for perfect clarity usually means missing the opportunity entirely. Buffett's long-term record is not built on avoiding crashes, but on surviving them without permanent damage. Survival allows compounding to continue, and compounding is the true engine of wealth creation. He encourages investors to measure success not by short-term performance, but by consistency over decades. Avoiding catastrophic mistakes matters more than achieving spectacular gains. In Buffett's view, the ultimate advantage is trust in rational thinking. Markets will fluctuate, economies will cycle, and fear will return again and again. Those who remain grounded in value, patience, and discipline will endure. The final message is clear: market crashes do not destroy wealth by themselves. Poor decisions made under pressure do. By controlling behavior, respecting risk, and trusting time, investors can transform market crashes from moments of fear into foundations of long-term success.